What if the world's second-largest economy is quietly preparing for a shock, the safest market on Earth? China has just sent a clear message to its biggest banks, and global markets noticed immediately. According to people familiar with the matter, Chinese regulators have advised major financial institutions to rein in their exposure to US Treasuries. The guidance urges banks to slow new purchases and reduce existing positions if their holdings are considered too large. This was not announced publicly. It was delivered verbally, and it did not apply to China's official state reserves. That distinction matters. This move reflects growing concern inside Beijing that heavy exposure to US government debt could leave Chinese banks vulnerable to sharp market swings. The focus, officials say, is risk concentration, not politics, but timing is everything. The warning comes as investors worldwide are rethinking what safe haven really means. US debt, once untouchable, is now being questioned amid rising volatility, ballooning deficits, and uncertainty over future policy direction in Washington. So what exactly triggered this? Chinese officials are increasingly wary of sudden moves in bond yields and currency markets. With US fiscal discipline under scrutiny and the dollar showing signs of weakness, large treasury positions can quickly turn from protection into risk. And the market reaction was immediate. US Treasuries slipped following the report. Yields edged higher across maturities in Asian trading. The dollar weakened slightly against major currencies. Not a crash, but a signal. This isn't just about China. Governments and fund managers across Europe and Asia are openly debating whether US debt still deserves its historic safe haven status. That conversation has been fueled by political uncertainty in the US, trade tensions, and questions surrounding the Federal Reserve's long-term independence. Meanwhile, US-China relations remain fragile. Although tensions have eased since last year's trade truce, uncertainty still hangs over the relationship. President Donald Trump recently held a phone call with Chinese President Xi Jinping and is planning a high-level summit in Beijing. But notably, this regulatory guidance came before that call. As of the latest available data, Chinese banks hold nearly $300 billion in dollar-denominated bonds. It's unclear how much of that is tied directly to treasuries, but even small adjustments by institutions of that size can ripple through global markets. And the backdrop is getting more complicated. Investors are increasingly concerned about Washington's fiscal trajectory. Trump has openly stated he's comfortable with a weaker dollar, a stance that helped push the currency to its lowest level in years. Lower interest rates, rising deficits, and policy uncertainty are adding fuel to the fire. Even major financial institutions are sounding alarms. A recent warning from a leading European bank suggested global money managers could start trimming US holdings if trade threats and political risks intensify. China's move may be framed as routine risk management, but in global finance, quiet adjustments often speak louder than public statements. This isn't a sell-off. It's not a decoupling. It's a warning. And when the world's largest foreign holder ecosystem starts reassessing US debt exposure, markets pay attention. Because if confidence in treasuries truly begins to shift, the consequences won't stay confined to bond desks. They'll reach currencies, equities, governments, and households. And this story is far from over.